In last class, we were talking about your first assumption for paper 3 when you're getting your discount rate, and that is the risk-free rate. So we've talked about the choices. You can just use the 10-year treasury. You can't do that without talking about it. I gave you an article that referenced by Damodaran. He talks about his approach while he argues for just using the current 10-year treasury. I talked about the normalizing approach, and I gave you some discussion there. And the last one was the forward rate. So if you go into the class notes, on page 12 of the class notes are some YouTube videos that show you how to bootstrap the yield curve. And you actually just do a search on the term bootstrap. It's the only place it's used in the notes. And it shows you how to bootstrap the yield curve, which is essentially you're going to use the 10-year treasury, but say in 10 years from now or 5 years from now. I forget what I do in the actual video. So those are in the notes on page, well, in the notes, just search for bootstrap and you'll find it. I don't know why it's called bootstrapping, but that's what I've always called it. That's what I've seen it in the notes when I was studying for the CFA exam. It's a very simple approach. So what I'm going to do here is I'm going to say, hey, so here's the theory. I won't give you the whole thing. It's in the video and you can watch the videos, but here's the whole theory is today I can buy a 20-year bond, 20-year treasury bond, and a 10-year treasury bond. I think in the video I do 10 and 5 years, but 20 and 10. Or I could buy the 20 and short the 10, and essentially that would give me a 10-year treasury in 10 years. That's essentially what it is. So essentially the bond market is telling us today what they think future interest rates will be, because you could do this trade. You could buy one longer term treasury and short a shorter term treasury, and you will get the treasury that is out 10 years. That is the 10-year treasury. It's a little confusing because we're talking the 10-year treasury in 10 years. If we did a 20-year treasury and a 5-year treasury, essentially then we'd be buying a 15-year treasury in 5 years. All right, so the treasury is 20 minus 5. I'm going to go back to 10, and the years is whatever the years is 10 years. That is whatever the shorter treasury maturity is. All right, so if I do that, and you can look in the notes how to do it, but I'll just show you. If I go into Google and just type H15, at least for me, I hope it does for you, but it brings the Federal Reserve, the St. Louis Federal Reserve. And if I do that and I click on that, it gives me interest rates. And what I'm going to do for the Treasury interest rate, you go to the constant maturity. Constant maturity just means, well, there may not be an actual 10-year treasury that the government issued today, but there's a 10-year treasury that has about 10 years left in its maturity, and that's the one they're using. So here we have the 10-year treasury and the 20-year. The 20-year is 105, the 10-year is 62. So so if the 10-year is 0.0062 and the 20-year, I've already forgotten, I have to go back and look, 62 and 105. So we look at those two. Then essentially what we're saying is the forward 10-year treasury That is the Treasury, what the market says 10-year Treasury yields will be in 10 years. I can calculate that. If I can type. And you'll see in the YouTube, I'm going to do it here real quickly, but in the YouTube, you just do 1 plus the longer term raised to its term. So 1 plus the 20 years, raise it to 20th, to the 20 divided by 1 plus the shorter term, which is the 10-year, raised to the 10. So we'll take 1 divided by the other and take that entire thing and raise it to the 1 divided by, in this case, 20 minus 10, the longer term minus the shorter term, minus 1. And that will give us 1.48%. That's the forward rate, 1.48. How do I know that's right? Well, if I were to buy the 10-year today and the forward 10-year, so the 10-year today is 0.62%. So if I were to buy the 10-year today and invest it for 10 years, that's what I would have. If I then took that at the end of 10 years and I was able to buy this 10-year Treasury at that rate for 10 years, my $1 would now be worth $1.23. That should be exactly the same thing as today, putting $1 into the 20-year for 20 years. That's $1.23. So I should get the same answer. I should be indifferent between buying the 10-year today and buying the forward 10-year. At the end of all time, I'll end up at $1.23. Or just put all my money in a 20-year today at $1.23. So the bond market is telling us they believe the 10-year Treasury will be at 1.48% in 10 years from now. Still a very, very low number, but at least it's higher than what we got by just using the 10-year. Definitely would be lower than what you'll get if you normalize the 10-year Treasury. So my forward is going to be about 1.5%. I might round it up to 1.5%. So I'm going to say that my 10-year Treasury, my risk-free rate is 1.5%. So that's going to be my approach in my analysis. So I chose to use the third approach. So my assumption is going to be 1.5%. And so I've got one assumption down, and just got what, 3 more to go, or 2 more to go, right? We got to get the market risk premium and the beta. All right. So, and we talked the theory down here, why if your beta is 1, it doesn't really matter which approach you use for coming your risk-free rate, because if your beta is 1, it doesn't matter. But remember what we talked last time: if you're a defensive company and you have a low beta, then if you use a really low Treasury, you're using a high market risk premium, and so that firm's going to be favored. If you use a really low risk-free rate and you have a high beta, then you're going to have a high market risk premium. You still have a low risk-free rate, then your market risk premium is going to be higher, and so you're penalizing that firm. So that's that discussion. You don't need to have this in your paper, but you certainly could put it in there if you want to prove to me and demonstrate you understand it, because it is an extremely important concept. All right, so we got one number down. So there it is. There's my first assumption. I'm going to highlight that in green, and then in Excel, I'm going to highlight it in green because that's one of my assumptions, 1.5%. So now I have my risk-free rate. Actually, I'm going to move it down here. So there's my risk-free rate. One number down, 2 to go for paper 3. So you see how we're working paper 3. We're just working one thing at a time. All right, so again, we're working through the capital asset pricing model. We've got one number down. Next, we're going to move to the market risk premium. So we've already walked through that theory, which is the implied approach. I want everybody to use the implied approach. It's just, if you're going to do a paper and do something besides the implied approach, your paper is going to be 50, 60 pages long because the other approaches take a lot more discussion. The other approach that I use, actually, when I started my career, with the historical approach. The historical approach just asks how much have stocks outperformed bonds historically. That was used for many, many years. There's a famous professor from the Chicago School of Business, Roger Ibbotson, who came up with that approach. And we used that when I started at UTSA. But since then, almost everybody uses the implied approach now. And here what we're going to say, the expected return, to do the market risk premium, we're trying to figure out what the required return on stocks is minus the risk-free rate. So the market risk premium, or the equity risk premium, is our required return on stocks minus the risk-free rate. And our required return on stock is what return do we need on stocks to compensate us for the risk of stocks. Stocks in general, not our particular company. You know that with the risk-free rate and the market risk premium, equity risk premium, you do not want to say anything at all is about your company. So the expected return on stocks, not your stock, but on stocks in general, is the dividend yield of the overall stock market plus the expected earnings growth of the overall stock market. If in your paper you talk about your company's dividend yield and your company's expected growth to come with the market risk premium, you will lose a lot of points. Be very, very careful, all right? Note, it is dividend yield and earnings growth for all stocks. Do not talk about your company here. It has nothing to do with your company. Your market risk premium is the same for every company you analyze. Doesn't matter. You're looking at the dividend yield of the market and you're looking at the expected earnings growth. So how do we get the dividend yield? I'm going to go back to my Excel. And so there's my risk-free rate. I'm going to move this down. So this top section up here is what I'm doing for the risk-free rate. And in doing that, I got 1.5%. So I round it up to 1.5%. So down here I have all my assumptions together. So my risk-free rate is 1.5%. So now I'm going to do a market risk premium analysis. Boy, my typing is pretty bad. So to do that, I need to have, I don't know what color I'll put this in, but we'll find a color. So to do this, we need a couple of things. So we're going to say the expected return on stocks in general, not my company, is the dividend yield plus expected earnings growth. So the dividend yield, I'm just going to take the current yield on the market, current dividend yield on the stock market, which I can get by looking at the dividend yield of the ETF SPY, because SPY is an exchange traded fund. Remember we talked about exchange traded funds. These are like mutual funds, but that trade like stocks. And so if I get the yield on the SPY, so I can go into Yahoo Finance, and it's interesting what the market is doing today. It was up almost 3% at one point, and it's not even up 1% now, but at least it's come back some. It was almost at zero. In fact, NASDAQ was negative there for a while. It's been a rocky day today. This is April 7th that I'm doing this. So I wish I knew what the market was doing when you actually watch this video in a few days. I wish I had that future knowledge. So here's the SPY, and it has a yield Boy, and its yield was 1.92 not too long ago, but now it's 2.25 because stock prices have come down, and that current yield is 0.0225. You need to look it up for the day that you're doing your paper. You can round this, so let's say it's 198 or 202. You can just round it to 2%. 225 is a pretty round number, so I'm going to use 225. But if you get like 223 or 228, or if you want to round it to 230 or 220, I like rounded numbers. The reason I like rounded numbers is to somewhat reflect that there's not such a great precision in this. And then expected earnings growth, I'm going to make that equal to expected economic growth. And we've talked about that before. You did that on exam 1 in your discussion, and that's going to be expected productivity expected labor growth, which right now is obviously negative, but we're looking long term, and then expected inflation. So to help you with these three things, if you go into our class and you look under files for papers, we looked at this before, but for papers 3 and 4, you have market equal data support. If you load that file, you'll notice a model or a file here that shows you the components of GDP growth. I'm going to use the snip function, and I'm going to take this and bring it in to my Excel file. You'll do it into your Word document. Shrink it down some. And so now I'm just going to put some numbers in. So productivity growth, I'm going to use 2%. You have to come up with your own assumptions and justify them. I'm not going to tell you my justification in words that you can exactly copy it into your paper. So you got to come up with your own assumptions. But the historical average has been about 2%. You might be able to argue, say 2.5%, but maybe I expect autonomous vehicles and artificial intelligence to push to higher productivity, whatever you want to say. But some rationale. But look at this. You can notice here the best decade we've ever had for productivity is 3%. We had about 2.5% in the 2000s. We've had very low productivity the last 10 years, but the average over the long term has been about 2%. So I'm going to think that makes sense. For labor growth, I'm going to use 0.005%. So it's going to be lower than historical due to retiring baby boomers, but offset somewhat with immigration. We'll definitely have a lot more people immigrating to the United States because as all these baby boomers retire and leave, we're going to have workers from outside of the U.S. come in, and fortunately we're near countries that have a higher birth rate than the U.S. has. So I'm going to use 0.5%. And expected inflation, there's a couple of ways you could do this on expected inflation. So on this one, I'm going to say see the chart and give your own assumptions. For inflation, there's a couple things you can do. You can say Fed is targeting 2%, or again, you can use tip yields. So I'm going to look at tip yields to come up with my assumptions. So again, if we go back to the Federal Reserve, we notice that the 10-year Treasury is 0.62%, and the 10-year tip is 0.46%. If you added those two together, so you know the difference between these two should be expected inflation. So you take the 10-year Treasury, you don't add them together. Take the 10-year Treasury and subtract the 10-year tip. You'll end up with, what is that, 1.08%. So you end up with a really low number. I don't like using the tips. So tips implies an inflation of only 1%. I think it will be higher than that. In fact, I think we have risk of merely high inflation due to government spending and Fed printing money. So I think we might see, right now everybody's expecting really low inflation. Now you can, if you watch my videos, a third approach that you can use here, you can use the forward break-even inflation. So if you want some extra kind of bonus points for going beyond, it's the same YouTube videos on bootstrapping. I show you exactly how to do that. It's a really cool idea. So right now, it looks like no one's expecting much inflation, but you might say, what is the bond market expecting inflation to be, say, in 10 years? And that would give you a much different number. So you might try that if you want to get into it. It's in those videos and they're not that long. I'm not saying this because maybe you get a few extra points on your paper. I'm saying it because it's really powerful, really valuable to know that. So I'm going to change this. I'm just going to say, hey, if the Fed is targeting 2%, I'm going to use 2%. So my expected economic growth is going to be my productivity plus my labor growth plus my inflation. So I expect the economy to grow about 5%. I think anything in the 4% to 6% range is justifiable. My expected return on stocks is going to be my dividend yield, 2.25, plus my economic growth. So anything in the 6 to 8% range makes sense in this environment. And so my market risk premium is going to be my expected return minus 0.015, my risk-free rate. Remember our risk-free rate? So 5.75. And so I got my market risk premium, 5.75. So now I have two assumptions. So the only assumption I have left to do is my beta. Let me move this graph over a little bit so it kind of gets out of our way. I'll put it right there on the corner. Wow, it'll fit perfectly. And so I've got two assumptions down, and next session we'll work on beta. You should be good on beta now because we've talked about it quite a bit, but we'll stop it there because this video is getting kind of long.